So let's talk about crypto's wild ride. We're going from its origin as a new kind of digital currency to, well, what it is now, a volatility engine supercharged by the age of AI. It started as one thing, but it's become something totally different. Let's dive in.
Okay, check this out. In just over 2 days, a crypto trading bot can pull in a return of more than 14%. I mean, at first glance, that looks incredible, right? Like a non-stop money-making machine.
But then you zoom out. At the exact same time, Bitcoin, the big one, is sitting about 40% down from its recent peak. And believe me, that's not even the whole story. Some other major tokens, they've crashed over 60%.
So what is going on here? How is it even possible for a market to have these insane extremes, huge wins and just crushing losses all at once? That's the real question, isn't it? And to figure it out, we've got to rewind the clock a bit.
You know, originally, this whole thing wasn't about Lambos and moonshots. It was a pretty radical idea. The dream was a brand new kind of financial system, one that wasn't controlled by banks or governments, something for everybody.
So think back to 2008. The whole financial system was melting down. And right out of that chaos comes Bitcoin. The goal wasn't to make a bunch of day traders rich. No, it was designed to be a simple peer-to-peer way to send money. No central bank meddling, a fixed supply so it couldn't just be printed into oblivion. The whole point was financial sovereignty, giving power back to people. It was about freedom, not flipping for a profit.
But you know how these things go. That original dream, it started to change. Something shifted, and crypto began to morph from this useful tool into, well, something else entirely. Just look at the difference. What started as a way to pay for things peer-to-peer, it's now a massively traded asset class. The dream of financial freedom, that's been replaced by a market that literally feeds on volatility. And the whole alternative to banking idea, it's become this crazy ecosystem driven by hype and social media stories.
So, you gotta ask, how did we get here? Well, it was kind of like a perfect storm. Suddenly, had all these exchanges making it super easy to trade. You had influencers on social media pumping up coins, and then came leverage, letting people make these massive, risky bets. All of a sudden, nobody really cared about using crypto to buy a pizza. The main event was just watching that price chart go up, up, up.
And just when you thought it couldn't get any crazier, a new player entered the game, a really powerful one, artificial intelligence. And it basically poured jet fuel on that fire of volatility.
This quote really nails it. Think about it. A human trader might get caught up in the story, the dream of a decentralized future. But an AI? It doesn't care. It has zero emotion. It's built for one single purpose, to find any little flicker of price movement and make a profit from it, period.
Okay, so how does this actually play out? Well, first, these AI systems are constantly scanning the market, finding these tiny little patterns that a human brain could never ever catch. Then, boom, they exploit them instantly. This kind of algorithmic trading just throws gas on whatever trend is already happening, pushing prices way faster. And here's the really scary part. This can trigger what's called cascading liquidations. It's like a domino effect of people being forced to sell, which causes the price to drop more, which forces more selling. And that's how you get those brutal, lightning-fast market crashes.
This all points to a massive fundamental problem baked right into the crypto world. It's a paradox, really, that explains almost everything about how it behaves.
Okay, let's compare two financial systems. Think about a regular bank. You deposit money, they lend it to a business, that business builds something or sells a service, the value is created out in the real world. Now look at crypto. For the most part, it's a closed loop. Money comes in and the profits are made from things happening inside that loop. Trading fees, mining rewards, that kind of thing. The money isn't really flowing out to build factories or create new products.
And that creates this impossible situation, a real catch-22, right? For crypto to actually work as a currency, for you to go buy a cup of coffee with it, the price has to be stable. You can't have your coffee costing $2 one minute and $20 the next. But here's the catch. That wild volatility is the exact thing that brings all the speculative money in. Traders love the swings, so if it becomes stable, the speculators leave. It just can't be both at the same time.
You always hear the comparison to gold, right? Digital gold. But hold on a second. There's a huge difference. Crypto is scarce because a line of code says it is. It's manufactured scarcity. Gold is scarce because it's physically hard to dig out of the ground, and we use it for things, like in our electronics. Let's put it this way. If all crypto disappeared overnight, it would be a massive financial loss, for sure. But if all the oil disappeared, society would grind to a halt. That difference is, well, It's everything.
And that brings us to risk. Look, if your bank goes under, in most places your money is insured up to a certain amount. There's a safety net. In crypto, there's nothing. Zero. That whole decentralized freedom thing sounds great, and it's a huge part of the appeal, but it's a double-edged sword. It also means if something goes wrong, if an exchange gets hacked or a project collapses, your money can just vanish. Forever.
All right, so we've looked at the history, the tech, the paradoxes. What does this all mean for you? What's the smart, responsible way to even approach this market, especially if you're thinking about putting some money in?
First things first, and let's be crystal clear on this. Crypto is not your savings account, not even close. It doesn't have the stability, and it definitely doesn't have the protection.
And on that same note, this is not for your pension, it's not for your retirement planning. That kind of investing needs steady, long-term growth. This market is pretty much the exact opposite of that.
So what is it then? Let's just call it what it is. High-risk, speculative exposure. That's it. Yes, the potential for huge returns is there, but it comes hand in hand with a very real, very possible risk of losing every single penny.
So what's the final word? Look, if you're going to get involved, you need to think of it like venture capital, like you're investing in a super early stage, risky startup. That means you only use money you are 100% prepared to lose. And maybe the most important thing of all, understand what you're actually buying into today, a machine that runs on volatility. Don't get caught up in the ghost of what it promised to be a decade ago.
Which leaves us with one last question to chew on. After all this, did crypto actually become an alternative to the financial system? Or did it just end up building a newer, faster, more chaotic machine that the old financial system now gets to play with? Something to think about. Thanks for tuning in.